Chapter 7, Problem 3 states that Acme Company's financial statements included in the 2018 Form 10-K reports the following amounts in millions of dollars. Revenues for year end May 31st, 2018 were $30,601. The net accounts receivable on May 31st, 2018 was $3,358, and net accounts receivables for the previous year was $3,434. The first task we have is to compute Acme's accounts receivable turnover ratio for the year ended in May 31st, 2018. We are to assume that all sales are on credit. First, I want to define what the accounts receivable turnover ratio is. An accounts receivable turnover ratio is a measure of the number of times accounts receivables are collected during the period. So basically, how many times they collect the money from their customers. It shows how efficient a company is at collecting credit sales from their customers. The equation for the accounts receivables turnover ratio is equal to the net credit sales over the average accounts receivables. Net credit sales is used because cash does not create receivables. It is normally found on the income statement. But for this problem, we assume that all sales are on credit, so we just use the revenues for the year end May 31st, 2018, which is $30,601. Average accounts receivables is calculated by using the accounts receivables from the end of the two most recent years. It is normally found on the balance sheet. For this problem, we will use the two amounts given to us right here. In order to find the average, we take the one from 2018 plus the one from 2017 and divide it by 2, and that'll give you approximately 9. Approximately 9. The second task is, what is the average collection period in days for accounts receivables? Explain your answer. So in order to find the average collection period in days, we use what's called the number of days sales in receivables. It is a measure of how long it takes to collect the receivables. So the number of days in sales receivables equation is the number of days in the period over the accounts receivable turnover ratio. So we assume that there is 360 days in the period for simplicity. It's basically a year. We just use 360 for rounder numbers. The accounts receivable turnover ratio we just found, and it is 9. Then we just divide the 2 and we get 40 days. It took 40 days for Acme Company to collect its accounts receivable on average. Then the third task is, do you think that the average collection period for sales to these customers is reasonable? What other information do you need to fully answer that question? So I've jotted down some notes down here to help guide the discussion. The first point is a higher ratio means faster turnover, or that they're collecting their receivables more frequently throughout the year. If receivables are returning over too slowly, the company's credit department may not be operating effectively. They may also be missing out on opportunities as they cannot use the cash to pay bills and other obligations sooner. They have to wait for their customers to pay them. However, too fast of a turnover rate might mean that the company's credit policies are too stringent and that sales are being lost as a result. In order to determine Acme Company's accounts receivable turnover ratio is reasonable, we first compare it with its payment policy. If the payment policy is 30 days, then customers are paying 10 days late because the average number of days sales and receivables was 40 days. However, if the payment policy is 60 days, customers are paying early. We also compare the turnover ratio with the historical figures of the company. We look to see if the turnover ratio has increased or decreased from previous years, to see if they're experiencing faster or slower collections. Finally, we compare the ratio with other companies in the industry. If our turnover ratio is higher than other companies or around the same as other companies, we're doing pretty well. If we are slower than other companies, we need to figure out what we're doing and what we can do better. This concludes problem number 3 from chapter 7.